Investors made significant portfolio adjustments in response to soaring benchmark lending rates, withdrawing record amounts from corporate bond exchange-traded funds, ETFs, and favoring lower-risk government equivalents, particularly US Treasury funds. In October, corporate bond ETFs experienced a net outflow of $9.4 billion, surpassing the previous record of $9.2 billion in June the previous year. In contrast, government bond ETFs attracted $30.4 billion, nearly doubling the September level, with a substantial portion flowing into US Treasury funds. This shift coincided with the surge in US government bond yields and lending rates, driven by expectations that the Federal Reserve would maintain higher interest rates to combat inflation. The US's key lending rate, SOFR, reached 5.3%, the highest level in 16 years. Investors, wary of a potential economic slowdown and widening credit spreads, showed a preference for the safety of short-term US Treasury bond ETFs yielding over 5%. Nate Geraci, president of financial advisor The ETF Store, noted, "The extra juice from credit isn't worth the squeeze of spreads blowing out." The trend of selling extended across the corporate bond market, with high-yield bond ETFs witnessing $4.8 billion in outflows. The iShares iBoxx Dollar High Yield Corporate Bond ETF, HYG, and SPDR Bloomberg High Yield Bond ETF, JNK, were notably affected. Even lower-risk investment-grade ETFs experienced significant outflows, totaling $4.6 billion, the largest since the COVID crash of March 2020. Todd Rosenbluth, head of research at Vetify Consultancy, attributed the sell-off to the anticipation of higher interest rates in 2024 and a low-growth environment in the U.S. Analysts expect this cautious attitude among bond investors to persist as long as risk-free yields remain elevated. However, opinions differ on the reasons behind the selling, with some attributing it to heightened volatility in October and potential seasonal tax loss selling in the U.S. While Treasury yields remained high, there was a broadening of inflows in the Treasury bond market. Investors, who had primarily focused on short-term bonds in recent months, also showed interest in long-term paper in October. Notably, emerging markets faced headwinds in October, with outflows of $3.2 billion from EM bond ETFs and $1.7 billion from EM equity ETFs, the first net outflow since mid-2021. The strength of the US dollar and the attractiveness of developed markets were cited as factors influencing sentiment toward emerging markets. Japanese equity ETFs, on the other hand, experienced an influx of $3.7 billion, largely from domestic investors. Analysts attributed this to rising inflation in Japan, prompting a shift in investment culture towards equities. As global financial markets experience heightened volatility and shifting economic conditions, investors are closely examining the implications of recent trends in corporate bond exchange-traded funds, ETFs. The unprecedented outflows from corporate bond ETFs and the parallel surge in interest for lower-risk government equivalents, particularly US Treasuries, raise several considerations for market participants. 1. Flight to safety amid rising rates. The substantial outflow of $9.4 billion from corporate bond ETFs in October, a record-breaking figure, underscores a notable shift in investor sentiment. As benchmark lending rates, such as the US's SOFR reaching 5.3%, touched 16-year highs, investors sought refuge in lower-risk assets. The flight to safety, primarily manifested in the influx of $30.4 billion into government bond ETFs, signals concerns about potential economic headwinds and a preference for the security offered by US Treasuries. 2. Economic slowdown concerns. Some investors are expressing growing concerns about a potential economic slowdown, which could widen credit spreads. In response, many are opting for the relative safety of short-term US Treasury bond ETFs yielding over 5%. This cautious attitude, as highlighted by Nate Geraci, president of financial advisor The ETF Store, suggests a prioritization of capital preservation over the pursuit of higher yields in the corporate bond market. 3. Impact on corporate bond market. The ripple effect of the outflows is evident across the corporate bond market. High-yield bond ETFs witnessed $4.8 billion in outflows, with notable impact on specific funds like the iShares iBoxx Dollar High Yield Corporate Bond ETF (HYG) and SPDR Bloomberg High Yield Bond ETF (JNK). Even investment-grade ETFs experienced their largest outflow since the COVID-induced market crash in March 2020. This suggests a broad re-evaluation of risk tolerance and a shift towards more risk-averse strategies. 4. Duration hedging with Treasury ETFs. Investors are strategically adjusting their portfolios in response to the Federal Reserve's commitment to keeping interest rates higher for an extended period. The flow of funds into longer-term Treasury ETFs, including active ones like PIMCO Enhanced Short Maturity Active ETF, MINT, indicates a desire to hedge against the possibility of the Fed failing to orchestrate a soft landing, potentially leading to a downward shift in the yield curve. 5. Emerging markets and Japanese equities. The October market dynamics also impacted emerging markets, with significant outflows from both EM bond and equity ETFs. The strength of the US dollar and the attractiveness of developed markets contributed to this trend. On the flip side, Japanese equity ETFs experienced a notable influx of $3.7 billion, reflecting a structural shift driven by rising inflation in Japan and a changing investment culture favoring stocks over cash. Conclusion. As investors grapple with the implications of the recent shifts in corporate bond ETFs, a cautious and discerning approach seems to be taking hold. The flight to safety, hedging against potential economic downturns, and strategic adjustments to interest rate expectations are key themes. Navigating this evolving landscape requires a keen understanding of the interplay between macroeconomic factors and market dynamics, emphasizing the importance of flexibility and risk management in investment strategies.